Hey guys, Freaky Finance here. 2 days ago we looked at Suncor, and today we're going to do Enbridge pretty quickly here. It's a long weekend this weekend, so I figured I'd pump out 2 videos. So, Enbridge is interesting company. Closure again, I own that one. It pays a pretty good dividend yield, 7.6%, so that's why most people are interested in it, is because of the income component. So let's dive into Enbridge. So first and foremost, you can see that their shift in assets, they've been putting quite a bit of their capex into gas transmission and distribution. So quite a bit of resources have gone there. So it's no longer, well, it still primarily is pipelines play. It has a material business in gas transmission and distribution. And you can see here the split out. So the orange is the pipelines, the traditional ones. The transmission for Nat Gas is this blue one going all the way down to Henry Hub here and all the way up to Northeast United States and actually back into Canada. And then they also have this interesting gas distribution service area, almost like a utility in Ontario. And you can see here they split out the 3 primary business segments. Your traditional pipelines that most people know Enbridge for, the gas transmission that's up and down the United States, and then you have the distribution again, the Dawn Hub. Pretty interesting group of assets, and for like how the company makes money, it obviously depends on the area or the business segment we're talking about, but the vision here on their 2020 or 2019 annual report was pretty interesting. So basically our assets are underpinned by long-term assets, regulated cost of service tolling frameworks, and other low-risk commercial arrangements. So basically most people like pipelines because it's predictable cash flow, right? And the tolling, so we talked about ATCO 2 weeks ago and how there's a regulator, and basically they regulate the dollar that they can charge you and me to use gas, right? Because we're not going to have a bunch of gas pipelines to our house, right? So under a monopoly, it's a similar idea, but with a pipeline. One, you're entering with contracts with other businesses, so it's not quite the same. You're just not a business against the consumer, it's a business against the business. But you also have multiple jurisdictions because pipelines are very long, right? So it's not going to be the Alberta. For ATCO is primarily the Alberta regulator, right? And for Enbridge, it's going to be wherever the pipeline touches. It has jurisdiction or regulatory rules in that specific area. And moreover, Enbridge has additional jurisdiction, I guess I call them issues right now, and predominantly with the United States and Canada. And generally, like, we've seen the trend of nationalization lately, not just in America, but around the world. Every country is starting to look more for themselves instead of for the collective whole. But anyway, I digress. So I want to talk about the tolling agreements because that's kind of the cornerstone of the free cash flow. And we'll see that when we jump in the numbers. But basically, on the mainland system, so the mainland system, we'll just call that the Canadian side, and the Lakeland system, we'll call that the American side. And so there's this competitive toll settlement where basically the CER, so the Canadian Energy Regulator, looks at it from the Canadian side and kind of work together this international joint tariff to work in the US side as well, into this IGT is what they call it, so International Joint Tariff. And these tariffs are denominated in US dollars. The IGT is designed to provide shippers on the mainland system with stable and competitive long-term toll. Basically, the people that need to move their oil, it's supposed to be fair, right? So Enbridge doesn't take the Suncors of the world to town. So we saw that on their transportation. Suncor's production was still fairly high in Q4. Therefore, the volume that they're pushing out through these pipelines, and some of them would be Enbridge, other one could be TransCanada, but let's just assume the Suncor's production was pushed through Enbridge's pipelines. The more volume that's pushed through Enbridge's pipelines at these specific toll fees is more cash flow for Enbridge, and that's kind of how it works. So Enbridge isn't a commodity play like the other producers are. It's more literally transporting oil, and that's on the pipeline side again. I'm going to keep regarding Enbridge as a pipeline play, but really it's bigger than that now. And this is what the tolling system looked like. So this is very neat. This is on the latest Q4. This is Fridays. So today's February 15th, and Friday was February 12th. This is the February 12th, and you can see the tolling, the IGT. It just slowly goes up, and look how uniform it is, right? 6 cents really every 4 quarters. That's been the trend lately. That doesn't mean it's going to persist like that, but you can see that it slowly increases up over time. And then they have these extra surcharges, and these are fairly steady. barely moving up. So let's jump to the numbers before I go through the outlier. I'm going to go fairly quick here. So their income statement is very interesting. So you're going to see right away, your eye should see 46 billion, 50 billion, 39 billion. So you're like, oh my god, I thought Enbridge isn't affected by COVID, right? It's a pipeline. So this is slightly misleading. It's because they have these commodity sales up here, and you can see the delta. This bottom line delta is predominantly driven by this commodity sales delta. But really, this is a flow-through sales. They don't make money on the commodity sale. And what I mean by that, here you can see the commodity cost. So the other end of the sales, you can see that also going down by 10 billion. So it's really a flow through. So I wanted to break that out down here because a lot of, you might hear like media say revenue down 10 billion year over year. It goes from 50 billion to 40 billion, right? And you're like, oh my God, I thought Enbridge was like a less volatile, more like a utility, right? And so that's what some people might pick up on, but it's kind of misleading. I just want to point that out down here when we do like the margin per line item on the income statement. You can see that Enbridge makes, well, they made 2% on commodity sales. The margin for $1 of sale was 2 cents, so very small in relation to their gas distribution sales. So that was that Ontario part, as well as their margin on actually transporting the liquid in the pipelines across Canada and into the States. And that also includes the Nat Gas side. But yeah, so you can see fairly actually increasing margins in 2020 on less revenue. So you can see operating income, the actual effect is fairly straightforward. You can see it went down 300 million, but on the whole, on a $808.3 billion operating income number, it's not that bad. I do want to point out that there is impairments here. So you're going to see this one was lower in 2018, and you can see right there 2.1 billion of the delta is from that. So we had that back, and you're back at 6.9, so closer to this. So Enbridge has been growing, and last year there was a minor effect from COVID. Now, one of the things you're going to see when your eyes dart down here is you're going to say, oh my God, the earnings per share got destroyed, right? Back down to 2018 levels. And what's going on there, because we just saw operating income was only down 300 million, is this line right here. So impairment of equity investments. So, and we're going to talk about this more specifically in a second. Enbridge invests in quite a lot of companies in the oil and gas space. So what that means, during the March panic, a lot of these oil and gas companies' share prices were falling dramatically. Some were pricing in bankruptcy. So what you have to do is you have to impair, if you think there's a reason for impairment, and sometimes the reason for impairment is literally the share price is going down so much, right? So what they did is they impaired $2.3 billion of equity investments. So you can see this is down about, well, year over year, you can see it's down about 2.4, slightly less than that, but just say 2.4. And you know 2.3 is from impairment of equity. So really, the bottom line here, it looks way worse, but that's because of an impairment of equity during the March panic. So it's not from the operations of the business. So what a media could say technically is that revenue was down 10 billion and earnings were almost halved. And technically they'd be right from an accounting point of view, but from the actual business performance, it would be a misleading title. So I thought that I should point that out because you might see things like that. Because these numbers just came out, you might see some headlines saying how bad it was. But really, it's not that bad. It's fairly steady business. And the company, well, at the end of December 31st, 2019, was at 51, and today's price is at 44.01. So the company is about 15% cheaper in my eyes on performance that's actually fairly steady, even if the earnings per share looks worse. It's actually very steady. The COVID balance sheet, the annual 2020 balance sheet, fairly stable. It is weaker though. So you can see here, long-term investments, that's that write-down, that 2.3 billion. You can see that direct effect here. So I just highlighted that. I didn't want to write out all the numbers this time. Got sidetracked yesterday. And the current assets went down in AR. But nothing too crazy on the top side. And long-term debt ticked up. So one of the things you want to point out here is that, depreciation was quite big. I didn't bring it up here, but you can see that depreciation is over $3 billion a year. So 3.7 in 2020. So your PPE should go down by that amount, right? But then you have to add back the CapEx. So CapEx is pretty heavy at Enbridge. This basically tells you that CapEx is going to be about, 5.2 or something billion. And we'll see that when we go through the cash flow in a second. But it is very PPE heavy. So you got 94 billion in PPE and 13 billion in long-term investments, which isn't small because it was just 16 billion, right? And who knows if well, so far some equity prices have started coming back for oil and gas, right? So some of these impairments that they wrote down, maybe there's a recovery in a bit, but who knows? Long-term debt, they'd pick up. That's what I was trying to say. That's how they plug the capex. They're doing quite a bit of work on line 3 right now. One of the headlines is that line 3 costs are higher than they were. They're kind of overrunning a bit. That's true. So that's how they fund their growth, right? And usually debt for pipelines is fairly cheap. Cash flow, probably the most important thing for this company, the statement specifically for this company. And you can see how stable it is because this nets out all the noise, right? You add back the depreciation, you add back all the impairments, and you get the real truth. You're sitting pretty. There is some working capital adjustments here, so I'd say this is about the same. And then your capex, about the same. So yeah, 5.4 billion. So I was pretty close with my estimate. So 5.4, and you're bringing in 9.7. So you're up about 4.3. And here you can see them issuing notes, you're paying notes, taking on extra paper, taking extra credit out of the facility. And then you also got these big dividends. So you're like, when you're first thinking, you're like, oh, they should be up quite a bit of cash if they made 9.7 billion and they reinvested 5.4. Investors should walk away with 4.3, assuming, right? So you can see here, they actually did pay 6.5 billion in dividends. So Enbridge pays a really high dividend, right? And that's what this line is picking up. It's saying, all right, so technically the CFO, the capex, didn't cover the dividends, and that's why they drew on some debt. That's how I read the statement. So, and that's what happened. That's what we saw in the financial statements. So anyway, what was this huge impairment? So when I go to their long-term investments on note 13, you can see DCP right here. Now all these got a little bit written down, right? Or most of them anyway. I can see some of them actually went up, but some went down. But this is the main one, going from 2.2 billion to 331 million, which is a big write down. And they have 50% interest in the company. So that's the one that stands out to me. We look at the extra note. Basically, they just say a decline in the market price for the publicly traded units during the first quarter of 2020, aka the March panic, resulted in another than temporary impairment loss of our investment. So they decided that this was going to be odds to be permanent loss. $1.7 billion hit that. When I look at the share price, I just want to look at it real quick. You can see this thing was at 21 bucks going into COVID. Bam, down to 3.5. And the quarter ended March 31st, right, for Enbridge. So they probably saw this and like, okay, we're going to have permanent capital loss here. We better write it down. That's what they did. However, the share price came back. So far, they haven't. When you write things down, you can also revalue them back up to the initial cost. So we'll see if they do that, because technically the reason they wrote it down was because the share price bounced back up. That could be some green lining, but again, it's not cash. It's just literally an item on the balance sheet that makes the earnings look better or worse. So the media might not understand it, but you got to look at the cash. And cash is king for Enbridge. The share price, so a lot of people view utilities and pipelines to be stable dividend payers, right? So Enbridge is one of those, but it is fairly volatile. You can see it's actually been in this trend, 35 to 55 for a while. Currently at 44. There's not a lot of action happening in the price chart. It's kind of what you'd expect for a pipeline play. So 2019 did look pretty good, and 2018 looked worse than 2019, so this kind of makes sense to me. And then 2020, you got this COVID panic, and it's trying to come back because the performance technically didn't degrade at all, right? We saw that in the actual numbers. There's an extra risk coming on here. I think that the market's trying to price in, or maybe it's just still COVID panic that hasn't recovered yet, right? It depends on your angle. So one of the things that's been happening is the line 3 replacement program. So the cost overrun of that basically is going, line 3 kind of goes from Hardisty in Alberta and goes down to the Superior refinery down here and the Minnesota and Wisconsin border. And then you have the line 3 replacement, which had a bunch of hurdles, like they were slowing down. Americans didn't really want to give Enbridge the rights to actually build this out, right? Because pipelines aren't very popular. In a weird way, it means that existing pipelines that are in place are probably more valuable, because it's going to be very hard to build new pipelines in this kind of world we've built. That's the line 3 replacement. This is the line 5. So Superior ended right here, right? So you have this Minnesota, Wisconsin border, Superior refinery, and then you have this going into Michigan, and then right here is this tunnel, and this is a source of a lot of angst right now. In Michigan, I think the governor ran on closing this pipeline. She's elected, so she's trying to close the pipeline. basically, my understanding from going through it real quick this morning was that this pipeline is underwater at this specific juncture. Over time, it's slowly been getting hit by boat anchors, and it's been denting the pipeline. So the government is saying, "Oh, it's not safe anymore. It's not structurally sound." Enbridge is like, "Well, we're planning to build a tunnel for it right now, basically, so it doesn't get hit anymore." And that's just my Cole's notes on reading through it really quick for like 30 minutes. But right now it's a standstill. Basically, they just want to shut it down and say screw that. And Enbridge is like, well, no, we should let us do our job and we'll try to make it more environmentally sound, right? So there's less risk of an actual leak. And part of the interesting thing here is that this infrastructure is like 50 years old, right? So I'm surprised. In my mind, I'm like, well, you should probably let the company build a better pipeline there. If you are worried about the environment, you should let them reduce the risk for you by mitigating it with a tunnel. Right now, it's still just about to get hit by another anchor. Who knows? But that's just my point of view. You can understand her saying, like, she got elected, right? By people who obviously think this is a big risk. And it is, right? If actually something were to happen. But the whole point of this is saying, Enbridge is saying, well, we're going to reduce the risk by doing this. And they're just saying, no, we just want to shut the whole thing down. So creating a bit of angst right now. And I think that's one of the reasons. And one of the risks with this company is like on the financials, it look very sound, right? But you have this risk and then you have this, and this drives volumes down, and then they make less money. And then you actually have the real economic repercussions of this because this is a fairly big line. You can have, like the people of Sarnia were probably, the unemployment there would be screwed. Probably along this channel would be screwed. From a jobs point of view, it kind of sucks. Who knows? Maybe you hedge that risk by going along the traditional Canadian freight, right? Because Suncor is going to need to get their oil to places to market. We'll see how this plays out. Maybe they'll compromise somehow. But lately, the government's been very ideological rather than pragmatic. But we'll see what this happens. But I think this is one of the reasons why the share price is still down where it is. It's because of this regulatory risk, and people are not sure how they should take it. Like, I don't really have an angle on it, right? Obviously, I'm bullish on it because the current economics look good. But how does Enbridge look without line 5? And honestly, how does, like, say this, because the Sarnia goes to, on this side, it's line 789. This goes to Quebec. It's not just Ontario as well. Like, Quebec has a lot of crude coming from this line. So it could make the logistics and supply line a lot worse for these guys. And even for Michigan, it'll probably be a lot worse from a cost point of view for energy, right? I think they're trying to jump the gun to renewables, but I don't think they really have a clue how much wind, how many wind turbines it takes. Yeah. But eventually they'll probably be able to do it, but I feel like, yeah, you're a little bit early. So back to what's good about it, the guidance looks pretty good again. You're seeing a slow, steady increase, going from 13.3 billion EBITDA, and they're guiding to 13.9 to 14.3. So you're almost going to get another $1 billion in EBITDA year over year, which is very nice. And you're still getting the steady cash dividend increase, and you're still getting the DCF per share going up. And their guidance is strong across all their business segments. I mean, they do include power in here. I didn't touch it on very much. They have some wind and stuff like that, but it's very small in the context of their EBITDA, though it's growing. And cost containment, they run a pretty tight ship at Enbridge, in my view. So you can see where the numbers are coming from. Quite a lot of the increase year over year is going to be pipelines, because volume did go down during Q2 and Q3 specifically. We saw Q4 increase for quite a few companies, but that should increase and make 2021 look better than 2020 did. It's an exciting time, right? So you have, on one end, you have superior economics of the pipeline and cash flow at a decent valuation because it's cheaper because of COVID. But at the same time, you have this regulatory risk, and one could argue that's one of the reasons why it's cheaper. So, and the company is kind of, I think in my mind, diversified itself smartly by going into the gas transmission. So that was that Henry Hub to the northeastern United States. That was smart. And then the gas distribution in Ontario is also smart in my mind. So to kind of reduce the exposure to any one area as well as any one regulatory spot. So the more diversified Enbridge is, the less risky it is in my mind, because right now, like, it would suck if they're like, nope, you can't use line 5 anymore. And then all these people and all the energy costs in the area will get slammed. But from my point of view, from an investment point of view, that would suck, because it still has a decent effect on the numbers. But if they keep diluting that over time by branching out, and that risk becomes less. And then technically, from my point of view, the share price should increase because there's less uncertainty then. I like that. So Enbridge, very interesting. Like I said, you have superior economics versus the regulatory environment and all the headwinds and people not liking pipelines. And yeah, I'd like to know your thoughts on Enbridge. It's harder to obviously quantify a regulatory risk like that. So, but I do want to point out that there is a risk there, right? A lot of people just talk about stable Enbridge, and that's true. But you have this underlying regulatory scheme, which has the potential to impact the share price, right? So you never want to go too big into anything, even if it's safe on the surface, like a Enbridge. But anyway, that's just my general thoughts. I hope you like this video. I went through it fairly quick, and have a great day.